Hi, and welcome back to the Business Career College video series. In this video, we're going to be looking at the 5 C's of credit. This is an important concept anytime anybody goes to borrow money. So when we're doing borrowing or lending, however you look at it, we have to examine the 5 C's of credit. Now, this video will be most useful for people who are doing a financial planning course. It's good for general interest, and it is something that's useful from any sort of financial planning or financial management question. It's not something that's necessary for students going through any of the licensing courses. If you're going through for your securities or mutual funds or life insurance, you won't need this right now, but it certainly is something that's useful to understand. So what the 5 C's of credit help us to understand is why somebody can or cannot borrow money. So oftentimes somebody will apply for credit, and what we're concerned with here is personal borrowing. The 5 C's of credit primarily refer to personal borrowing. Corporate borrowing is a little bit different, or business borrowing is a little bit different, but the 5 C's help us to understand the factors that go into a determination around borrowing money. So the 5 C's then, in no particular order, are collateral, capital, character, capacity, and conditions. In some cases, there are very specific items we look to determine whether or not borrowing is going to be available to you. In other cases, it's more big picture or conceptual. So collateral says, is there an asset that the lender could grab onto if this debt isn't paid? And when there's good collateral, that's when we're permitted to access secured lending. And examples of secured lending include a mortgage or a home equity line of credit. And most investment lending as well. A lot of investment lending is going to be secured, and that means that we have good enough collateral that the financial institution is confident making this loan because there's something that they can grab onto. We could contrast that with unsecured debt, and generally unsecured debt is easier to acquire. However, you lack collateral, and as such, you're going to typically pay interest at higher rates and maybe have more strict terms and conditions for your loan. So credit cards are a good example of unsecured debt. That is, there's nothing to back that up. You might have, say, a student line of credit as another example of unsecured debt. So the question here is, what's the amount of collateral? What's the quality of that collateral? And how easy could the lender actually get at that particular collateral? So then we look at capital. So your capital, this is your net worth, is the primary measure of capital. And we do have other measures of capital, such as your debt to equity or debt to asset ratio, and debt to asset ratio. So these are measures of the extent to which you yourself are capitalized, or the extent to which you have built up some wealth on your own. And a lender looks at this and says, well, if this person was able to build some net worth, or if they have healthy debt to equity or debt to asset ratios, then they've done a good job of looking after their own financial situation. They probably will take our financial obligations seriously as well. Character is one that most people are generally familiar with, even though they don't recognize it. This is where we look at our credit score. And your credit score, or Beacon score, or credit bureau, or whatever name we happen to apply to it, it doesn't really matter, is a reflection of how you've treated your lenders. So have you serviced your debts? Seriously, that is, have you actually continued to pay debts on a scheduled basis at the rate the lender would like you to pay them? Your credit score reveals other things too, such as your maximum available credit and how much of that credit you've used. And often character is the item that we point to first when we're identifying the 5 C's of credit, but in fact it's only one of the 5 factors. It's quite important, and it's one that people can readily understand. It's also one that we have access to. The credit rating agencies like Equifax and TransUnion will give consumers access to their own credit reports without too much fuss. So typically one free credit report per month from the credit rating agencies. And that's something people can easily see, and it's something that people are often familiar with. Capacity. So your capacity to borrow money, this is another one that people may know on their own, and this is where we look at your total debt servicing ratio, your TDS, and your gross debt servicing ratio, your GDS. And these are both quite important ratios, typically where you're borrowing money for housing purposes especially. And your total debt servicing ratio takes into account your housing costs plus all your debts, all your debt servicing requirements. And we divide this by your gross monthly income. So we take all of those figures every month and divide them by your gross monthly income. Your gross debt servicing ratio then, we're simply going to take your housing costs, and housing costs includes your what we call PIT, or your principal, interest, and taxes. That is the actual stuff you have to pay on a mortgage. And usually we incorporate 50% of heating costs to get to your housing cost as well. I apologize, sorry. You're going to take your full heating costs. Step ahead of myself there. Your heating costs, and if you have condo, also 50% of condo fees. And again, you would divide that by your gross monthly income. And these figures have different targets depending on the lender. We're going to talk more about that in a second. Typically for TDS, a lender is going to cap this at somewhere up to about 44%, usually somewhere between about the 35 to 44% range. Now 44% is quite high. That would be unusual conditions that would lead to that, but somewhere in this range. And then your GDS, this is typically going to be capped at somewhere in the 25 to 35% range, typically more in the 30% range, but it can be a little higher or a little bit lower. And it's hard to know what those figures are. Lenders may not be completely forthcoming with what their actual specific lending requirements are. And then we look at conditions. So the conditions actually tie exactly into that discussion. And when we talk about conditions, we talk about basically the ease of borrowing. So this is the difference between borrowing when banks are free with their money and borrowing when banks are tight with their money. And typically, when banks are free with their money, they'll relax some of the conditions around your capacity, character, capital, and collateral requirements. Or when banks are going to be tight with their money, then it's going to be very difficult and you'll have to meet very stringent requirements to borrow. So this basically refers to stuff that is outside of your individual control, things that would cause you, maybe last week you could have borrowed money easily, but this week conditions have changed, nothing in your personal life or your financial life, but something has changed outside of your control, and now it maybe takes you offside from being able to borrow. We will examine certainly character and capacity in later videos. There's a fair bit more to examine there. We even will look at capital a little bit in a future video, more with respect to some corporate ratios, but we'll certainly work to understand debt to asset and debt to equity ratios. So I hope that that helps to understand the basics of borrowing, why people can or cannot borrow money. And most times when somebody is turned down for some lending that they've applied for, we can directly tie it to at least one of the 5 C's. So again, this is very useful from a financial planning perspective, and it is something that affects all people as they attempt to use credit. I hope you found this useful, and I hope you enjoy your continued studies. Thank you kindly.